Guys, welcome back to the Independent Investor Channel. My name is Ryan. I'm going to strike at the core of something that I feel is missing across the investing landscape, and that's to control your risk using scale. I say this all the time when I'm talking to new investors. A lot of new investors think that they just have to take whatever they've saved up and dump that whole thing onto the stock market. And I think you need to use a little bit deeper thought before you do that and really give yourself a chance to set yourself up for the best opportunity to succeed in the stock market. So many people will get involved. 6 months later, they're out. They'll get involved and they'll quit. They'll get involved and they'll get discouraged. And I think if we can strike at the root of that problem, which I contend that new investors really, they want to do the right thing, but they're not giving themselves that ultimate shot by controlling their scale. And in this video, I'm going to walk through a couple different ways that you can consider before putting capital to risk, to take into consideration to try to better align the risk that you're taking in the stock market with your own personal risk tolerance, all right? Number one, when we're talking about introducing any starting amount of capital, whether it be $1,000, $5,000, $10,000 in the stock market, my offering is this: start small. If you have saved up over the course of a few months or a few years and you really want to get started in the market, I think contrary to belief that you have to just take that entire amount and put it into the stock market all at the same time, I really think that goes against what a lot of people should be doing. And that is starting from a defensive perspective. If you have $1,000 to invest in the stock market, why don't you consider investing 25% of it? Start there, all right? I think way too many people start on the 100% scale and think that that's their only option. They think if they don't get into the market quick enough that they're going to somehow miss out on an opportunity, and that's just not the truth. I think a better approach is to earmark that amount that you want to have invested ultimately in the market, but you don't have to invest that all at the same time. And this goes along with the theme of starting investing in the correct manner, really opting for that premium account that I talk about all the time through starting the Roth IRA of a self-directed nature. That is the key. That is the absolute flagship account that you should be looking at first and foremost to get started. And then put that 25% in there. Now, be advised, that 25% out of $1,000 is really not going to make you rich overnight, okay? And I think having realistic expectations that $250 is not going to make you rich overnight, and it's not going to double the next week. It doesn't happen that way. You're going to watch your money flow in and out. What you do to supplement that small seed that you've planted in the ground with that $250 position is to make sure that you're abiding by some of the fundamental premises that I talk about. Starting the right account and then starting your account on a funding schedule that's going to get you conditioned to paying that account first. $25 is adequate, right? Now you have that 75% out of that first $1,000 put aside in hopefully a high-yielding savings account or a savings account that's available to you in case of an emergency. That way you don't have all of your capital exposed to the stock market and you're there twiddling thumbs wondering why it's not going up fast enough. The stock market will only pay patient investors over time. If you expect to get rich overnight by overexposing to the stock market, you're probably setting yourself up for more disappointment than you think, all right? So start small. Do yourself a favor. I can guarantee you this. If more people gave themselves a fighting chance to get used to invested capital, acting like invested capital, more people would succeed in the market rather than overexposing and getting scared off of the market, okay? Number two, very important point, don't try to buy the market all at the same time. When you're starting in the market, please acknowledge that that's exactly what it is. Don't tune into a YouTube offering with a seasoned portfolio that's been built over many, many years and try to replicate that overnight. It's going to run you the risk of overexposing, and it's going to run you the risk of not starting small and giving yourself that fighting chance. It may very well be one or two positions that you're able to buy right up front. So I know there's a lot of beginning investors that they look at a 30 stock portfolio and they get wide-eyed and they really want to get involved. They want to start that dividend income. But going back to rule number one, starting small and trying not to buy the market at the same time, I always would encourage everybody to start with a nice diversified product to start. That's going to help. And that actually does allow you to buy the entire market within one product. But if you're looking at single stock, I find this all the time where people really water down the portfolio and they put a bunch of holdings in there and they pack 30 holdings into their portfolio with only $1,000. That's really going to water you down. If there's one or two starting positions that you want to take, by all means, you can do that. But make sure that you have fair expectations for those stock positions that you're going to initiate in the portfolio. Number three is to diversify to start. I always encourage new investors that if they're looking at different programs or different strategies to invest, passive investing with ETF, index fund mutual funds, or single stock, or any other variety of investing options that you have out there, to make sure that you're really considering the benefits of just diversifying to start. Diversifying through a nice broad-based ETF, an S&P 500 ETF or index fund will work in this manner. And getting up to that first $10,000 or $25,000, whatever benchmark you earmark, before you start diversifying into some single stock exposure in your portfolio, if that's what you desire, okay? This is going to do many, many things for you. It's going to get you used to your money fluctuating in value. It's going to provide you that defensive buffer in the market by providing you that instant diversification. Owning the S&P 500 is in fact diversified, and you can do that by owning one product. The one that I like is VOO through Vanguard. That's the one that I personally own. A lot of brokers have their own version of the S&P 500, but that's a good place to start. And if you rationalize and make sense of it, you can really come to terms with the fact that this very strategy can help you control risk by using scale, okay? It allows you a lot of bang for your buck by just buying the entire market up front. Then you can do the exact same things that I talked about in the previous rules, right? You can fund that up, you can set it for dividend reinvestment, and you can live to fight another day. You're guaranteeing yourself automatic exposure to the largest cap companies in the United States stock market over the long term, and you can sleep easy owning these products, which is another very key point that I'm going to get to. Number four is to buy quality. All right, buy quality. ETFs that run at a passive clip and a very, very low expense ratio will help you and give you the very best shot at realizing your financial goals down the future. What I mean by that is don't try to get cute with this. If you're intrigued by Tesla, or if you think investing is about finding the next best thing, you are sorely mistaken, okay? The best way to approach investing is to do what's fundamentally worked over the last many, many decades, and that is opting for the best quality. Those companies that are and have rewarded stockholders over time by paying a nice, healthy dividend, that have healthy balance sheets, that provided real value back to shareholders. And by looking at it from that perspective and looking at just becoming a participant in these fine businesses, you're going to find that investing is so much more enjoyable for you because you're not entering into investing to somehow twiddle your thumbs or cross your fingers and hopefully strike it rich in the stock market, okay? Riches are made in the stock market over the long term, not the short term, okay? So please keep that in mind. And the last and final thing that I'll mention on this, which is the most important aspect, if you deploy the four strategies that I've mentioned before, as I do in my own personal investment strategy, This one is one that is absolutely key, and it is very, very unique to the independent investor channel, and that is to understand your advantage. Understand your advantage. It's worth saying twice. As a self-directed investor, remember, you are taking a risk to invest. There is no investment out there that doesn't involve risk. The key takeaway is that you do not have the involvement of a money manager in your program. Why is that important? It's because that you'll take the same amount of risk, whether or not you're a self-directed investor or you work with a money manager. It's the same amount of risk that you take to the exact same stock market. But in this scenario, you take the risk and you keep all of the profit. In this particular case, in the managed portfolio, you're also taking the same amount of risk, but you're also paying for that level of service. And by nature of paying for that level of service, it's going to hamper your portfolio's ability to perform at maximum potential over the course of your life. And this typically really rears its head after decades have passed. You're not going to notice it after the first 10 years. You may not even notice it after the first 20 years. But I can tell you after 20, 30, 40, even 50 years with a money manager, that decision right there to opt for a money manager is going to cost you hundreds of thousands of dollars over the course of your investing life. So to understand your strategic advantage allows you to more easily deploy some of the strategies that I've talked about in this video because the odds are on your side. You can afford to be a little bit more defensive. You can afford to keep a little bit more cash on the side and use scale before you introduce any level of risk to the stock market. Because yes, where you're taking the same amount of risk, you're also going to render all of the rewards that come out of deploying a little bit more of a defensive strategy on the self-directed investor side. Guys, thank you so much for tuning in to this video. Super important to control your risk using scale. The point of this video is to align your risk tolerance with the amount of exposure that you're putting into the stock market. If you align those two, you're setting up yourself up for so much better success into the future and so much more potential to stay the course with your program. Guys, subscribe to the channel if you would. If you enjoy the message that we're putting through, leave your comments at the bottom of this video and share this video out there with anybody that you know may be struggling with, considering getting involved with investing and is just looking for a place to start. Bring them onto the channel. We'd love to have them. We break down these very simple fundamental keys to investing, and we're opening up the door so that everybody can look to become a participant in whatever degree that they choose in the market. Guys, thank you so much for tuning into the video, and good luck in your investment future.